Welcome back, guys, to another episode of 5 Minute DD. Today we're talking about the income ETF BIZD. This is a really interesting one, and not a lot of people seem to talk about it, but I wanted to put it on everyone's radar. So for those that are new to the channel, this is where I do a bunch of research on a stock or an ETF or an ETN. I put a bunch of the information that I want to know before I was to buy it into basically a cheat sheet, and we go over it. We talk about the pros and cons, and I give my opinions on it. Of course, not financial advice, but I like to know what you guys think about it too in the comments down below. It also helps me if you like the video. That boosts it more, helps the algorithm. And if you're interested in this content, please subscribe. We've been growing. We grew like double the last month. So this is a pretty fresh new channel I've been working on, but I appreciate that if you guys are interested in stock content. So let's go ahead and jump right into the pros of BIZD. It's got a nice 11% dividend yield, very impressive yield. Diversity. So for those that don't know what this is or are unfamiliar with it, it's basically an income ETF based on owning a large portion and a diverse portion of different BDC companies. So we'll talk about the companies that they have in this. I'm sure you guys maybe own some of them or have at least heard of them. It's extremely interesting, and it's a really good concept in my opinion because it gives you the high yield of all the BDCs, but it also gives you some security with each BDC. If something were to happen, say you own Ares Capital Corp, ARCC, something goes wrong with that one and it drops 30%, your BIZD will take a hit, but not nearly as bad of a hit. It just gives you that diversification that's so important in the market. The dividend history is pretty intense. Let's go ahead and look at that. I'm using NASDAQ.com. And so we can go all the way back to the inception of the fund, which is 2013, and they started paying out some dividends very quickly. Now, they haven't missed a dividend since the inception of the fund, which is important. That's another pro that I talked about or I included in the list. Now, because they do not control the amount of dividends coming through, they cannot pay out a certain amount every time. It can't be consistent. So a little bit of a negative there, but that kind of comes with inconsistent dividend, actually brings in more safety because of the diversity. So as we can see, they've been growing the dividend over the past couple of years, about 2 years. It went from 31 on the low up to about 42 on the high. And so that's basically just a reflection of how the market has been doing. It got really beaten down and then is now starting to bounce back up. And we're seeing higher dividend yields from a lot of these BDC companies, which is excellent. So the dividend history is pretty strong. Not a super long history. I usually like at least a 10-year history. This one has just a 10-year history almost. So it's good enough for me, but of course I want you guys to do your own research and make your own decisions. That's just my opinion. 10 years of dividend history is adequate. And now the last thing on our pro list is their expense ratio, 0.40. So this is a really good expense ratio. 0.6 I believe is the average, so a little bit below average. I shouldn't say a little bit, 33% below average. Very impressive. I like when they have lower expense ratios. It just means more money in your pocket. And I don't know if this one is actively managed or if it's passively managed. They definitely would have that on here. I usually don't have a preference. I'm just asking because typically the actively managed ones have a higher expense ratio. So I would assume that this one is passively managed, which can be a good thing or a bad thing. It just depends on what you believe in the sector, pretty much. So I'll link the investor portion of their website down below. You guys can go check it out for yourself if you're interested. Read up on some of the things that I'm going to kind of skip over because I want to keep this video short and sweet. Now let's go over their holdings. Ares Capital is their largest. And then there's FSKKR Capital. I've never heard of that one, but I will be looking it up. I do think it's interesting how they have such large portions in Ares and that one. And then Owl Rock, one of my all-time favorites. Main Street Capital, another great one. Really, really popular. PSEC, Prospect Capital, really good. So what I like to do with these is not only learn about the different stuff that they have in this ETF, but you can also find other BDCs that are popular, maybe that you didn't know about. Like, for instance, when I was filming this, I had never heard of a couple of these. PSEC, of course, I've heard of that one, and Main Street are super popular, but there's more you can learn from these types of ETFs and see how they perform and how these stocks have performed in the past. So it just gives you more diversity. Say you really like one of them and you don't think the fund holds enough of it, you can start a portion you can start a position in your account of just that one that you like. Maybe you do some research on it, figure all that out before you buy. But that's also helpful for research overall. I like doing that because it helps me. I have more content for making videos on all different platforms. So it's definitely beneficial. If you guys are interested, you can check out my other socials in the description down below where I do short form content on TikTok. And then my website has a blog, of course, that I talk about a lot of things on if you guys are interested in finance. and do some financial coaching through my website. Now we'll jump into the cons of this ETF. Price appreciation. We're going to jump to the 5-year chart. Down 4.31%, not terrible, and their max chart really bad, down 23.61%. Now, normally this would rule out a stock, an ETF for me, because the max chart is extremely important. But looking back to when they went public in 2013, the market did do really well. So I would want to know more about why they were down 17% before the pandemic dropped, and how they're going to kind of overcome that. Now, they did bounce really nicely after the pandemic plunge all the way back up to pre-pandemic highs even, but still beaten down, and I would want to know why. There's not a whole lot of information about this. I'm sure if I did a deeper dive and gave it a few more days of research into this, I could see why. But the interesting thing is their dividend was lesser back then, which could have been a little bit off-putting. It was very sporadic, and so sometimes investors don't like that, and it also comes down to management. They could have had a management switch up. Again, there's a lot of things that could have happened, so this one is still a little bit speculative for me because of this, but for now, that 11% dividend yield is pretty phenomenal, and price appreciation is not what you typically go for if you're looking at ETFs, at least some ETFs like covered call ETFs or BDCs or REITs. You are doing it for the dividend, and because this one has been pulled back a little bit, it's a little bit of a better deal in my opinion. The next con is inconsistent dividend yield. We see this a lot with different companies, with some ETFs. Same thing with some covered call ETFs like JEPI, QYLD. It's a little bit of a negative. You can't really be, if you were expecting to get the same amount every month, it would be difficult. This one also is a quarterly payer. It does not pay monthly. But that can be tough if you're like, say, you want to put your car payment or have it fully covered by this fund. You would have to have extra in there for the months where it didn't perform as well. So that's just something to note. It's not a terrible con as long as that dividend yield remains consistent. And lastly, the max chart, which is like I talked about with price appreciation, it just scares me a little bit. And to know that their 52-week low is $13 and they're at 15. 52-week high is $18, so they're sitting right in the middle pretty much of their low and a high. And that's not terrible because we were expecting these ones to trade sideways. So lastly, again, not financial advice, guys. I appreciate you guys for watching the video. Let me know in the comments what you think. I'm always open to criticism of any sort. And again, if you could like, comment, subscribe, that helps out the algorithm a bunch. And I hope we can continue to grow this channel and provide some useful information and gain some information back from you guys, because you guys are super helpful in finding stocks that I should do videos on and all things of that sort. So as always, thank you guys for watching, and I hope you have a good rest of your day.